Have you ever wondered why your paycheck never seems to stretch as far as it should? Why prices rise, debt grows, and yet the money in your bank account feels smaller? What if I told you that every dollar you've ever earned, every penny you've ever saved, is quietly controlled by a system most people barely understand, a system designed not to serve you, but to serve a very small, very powerful network of financial institutions? It's not conspiracy theory. It's history, hidden in plain sight. And today, we're going to uncover how central banks, these seemingly invisible institutions, have shaped the value of every dollar you've ever earned. To understand how central banks quietly control your money, we have to go back a long way. The modern banking system didn't emerge overnight. Its roots trace back centuries to the goldsmiths and merchant bankers of medieval Europe. In England, goldsmiths discovered a curious trick. People would deposit gold with them for safekeeping. The goldsmiths realized they didn't need all of it at once. They could lend out most of it while keeping only a fraction on hand, an early form of what we now call fractional reserve banking. Fast forward a few hundred years, and the United States is in its infancy. The Founding Fathers debated endlessly about banks. Alexander Hamilton argued for a central bank to stabilize the fledgling economy, while Thomas Jefferson warned of a dangerous concentration of financial power. Jefferson's fears, it turns out, were more prescient than many realized. The stage was set for a hidden system of control, a system that would grow quietly, invisibly, and almost irresistibly. The first true central bank in the U.S. was the First Bank of the United States, chartered in 1791. It was modeled on England's Bank of England, which had been quietly controlling British finances for over a century. At first glance, these institutions seemed benign. They issued currency, managed debt, and stabilized economies. But there was a catch. The currency wasn't just money, it was debt. Every dollar in circulation was a promise of repayment, often backed not by tangible wealth, but by trust in the bank itself. This meant that central banks didn't just manage money, they controlled the terms under which money could exist. They determined how much debt would be allowed, when interest rates would rise or fall, and ultimately, how wealth flowed through society. By the early 20th century, the system had evolved into what we now recognize as the Federal Reserve. In 1913, the Federal Reserve Act quietly created a network of regional banks under private ownership but with public authority. Dual structure that would allow control without direct accountability. The Fed's mandate, on paper, was simple: maintain economic stability. In practice, it gave a handful of private banks unprecedented power. Through interest rates, money creation, and the management of national debt, these banks could influence everything from mortgage rates to the stock market to the purchasing power of the dollar. During the 1920s, this invisible hand became glaringly apparent. Easy credit fueled speculation, and when the market collapsed in 1929, it wasn't just bad luck, it was the outcome of a system designed to expand credit, profit from interest, and then consolidate power during crisis. The Great Depression exposed the fragility of a financial system built on debt. Millions lost jobs, savings, and faith in money itself. But here's the twist. While ordinary citizens suffered, central banks and their allies were already engineering solutions that would strengthen their control. By the 1930s, the Federal Reserve had learned a crucial lesson. Crises could be exploited. By controlling credit and currency supply, central banks could stabilize markets. You'd destabilize them depending on whose interests they prioritized. Post-World War II, the Bretton Woods system appeared to democratize global finance. The US dollar became the world's reserve currency, pegged to gold. Nations around the globe now depended on the dollar for international trade. But under the surface, this stability meant central banks could manipulate economies globally, simply by adjusting credit, interest rates, or dollar supply. In 1971, President Nixon ended the gold standard. Overnight, dollars became unbacked by physical commodities. What was left? Pure trust and control by central banks. The Fed could now create money at will, injecting liquidity into markets, fueling inflation, or tightening supply to encourage debt repayment. The result? The average worker's money buys less each year, while banks profit on the interest of debt they effectively create from nothing. Housing bubbles, student loans, and national debt all follow this pattern. The system is designed to perpetuate itself, extracting wealth silently from the many to enrich the few. Governments have tried reforms Glass-Steagall, quantitative easing regulations, even temporary freezes on banking practices. Yet each fix is partial and temporary. Why? Because the system is self-reinforcing. Central banks don't just manage money, they manage the incentives of the entire financial ecosystem. Every attempt to rein in their power either fails or strengthens it in disguise. The very tools designed to stabilize economies often deepen dependency, ensuring that individuals, corporations, and nations remain tethered to the decisions of a few elite institutions. Today, the pattern repeats on a global scale. Central banks in Europe, Asia, and the US create trillions of dollars in digital money, often invisible to ordinary citizens. Household debt rises, inflation quietly erodes savings. Every financial crisis, every bailout, every stimulus package reinforces the same cycle. Consider this. The U.S. national debt now exceeds $33 trillion. Yet the cost of servicing that debt to interest payments transfers hundreds of billions annually from taxpayers to banks. Meanwhile, central banks quietly manipulate rates, ensuring debt is sustainable only if the system itself continues unchallenged. It's a system designed for control, not fairness. And the more things appear normal, the more invisible the mechanism becomes. Debt is the tool of control. Every dollar exists as a promise of repayment, giving banks influence over every transaction. Crises reinforce power. Economic collapses aren't. Random, they are often opportunities for central banks to consolidate influence. Reforms are temporary, the system is self-reinforcing, and conventional fixes rarely address the root mechanisms. If you think your money is truly yours, think again. Every dollar is a node in a vast network controlled by institutions few understand and fewer can influence. The real question isn't whether this control exists, it's how long it will remain invisible, and what happens when it's finally recognized. If you want to understand the hidden mechanisms that shape your financial reality, hit subscribe and turn on notifications. We'll continue uncovering the secrets of money, debt, and the invisible forces that govern our lives. Knowledge is power, but only if you act on it.